URB's a listed investment company. It's based on the thematic of urban renewal and regeneration. It's specifically the portfolio consists of two components. There's a listed direct equities component, which is focusing on companies that are going to benefit from that theme. So we're talking there about population growth, urban renewal, revitalisation of town centres. The second part of the portfolio is a direct property component. So there the investment manager's focusing on underutilised and underdeveloped properties that, again, where they identify a future driver of revaluation on account of these forces of urban renewal and regeneration. So a good example there is sort of a major infrastructure development going on in a particular area. So how do we see this as a differentiated investment vehicle? Well, it's a strong thematic play, and it's the only investment vehicle in Australia at the moment that specifically targets that urban renewal and regeneration theme. I think that in itself presents a value proposition. If we look at it purely from an investment perspective, if you look at the direct equities portfolio and historically backtested, the correlations actually to the broader ASX 200 are actually relatively low, and that's predominantly because it excludes the financial services sector and resource sector, and most mums and dads investors are very overweight. So that's a point of difference. And obviously the direct property component will exhibit, well, very, very low correlations to a direct equities portfolio. But again, it's specifically targeting that urban renewal theme. And if you get that right, and the investment management team have experience in that, have a proven track record, if you get that right, then obviously you're going to get some solid longer term gains. The LIC structure is the company structure. The benefit of that, and particularly with a direct property portfolio, is it allows you to retain profits. So the strategy here is the direct property, the revaluation event occurs, the one that's been identified by the management. At that point, they'll likely sell the property and recycle their capital. So you get a realised profit. Now, if you can retain some of those earnings, then you can manage the dividend payment over future years. So we're expecting a fairly stable and relatively high dividend payment, which is beneficial, I guess, in particular for investors in the retiree stage. The management fees are low. I mean, the MER is 50 basis points, which is certainly competitive. It does have a performance fee, which is 15%, but the hurdle's actually very aggressive. If you look at it on the total returns basis, it's actually probably around the 12%, so that's quite an aggressive hurdle. So a very strong, I think, fee structure, and one with that performance fee hurdle that creates an alignment with shareholders. The other thing in terms of an alignment of interest with shareholders, the guys here, the shareholders of Contact Asset Management, the investment managers, are actually going to be co-invested in the fund itself, which is always a good sign. As I said, there's two parts to the management team. You've got the guys who are running the direct equities portfolio and who also have oversight of the whole vehicle. That's Contact Asset Management. That's newly formed in October last year, but it's actually got a 13-year track record with BKI Investments Limited, which I'll continue to run. Solid track record there, I think 11.3% total returns per annum over its 13-year track record. And the investment approach that they've been using in BKI is the same investment approach that they'll be using in URB, so it's a proven and tested methodology. And then the guys who are running the direct property component, Pitt Street Real Estate Partners, they formed about 7 years ago when they teamed up with Soul Pattinson, and again, this is actually the strategy that they've been pursuing all that time. It's actually focusing on properties that are really going to benefit from urban renewal and regeneration. So they have a track record there. Most of the properties that they've purchased are still being held, but there's been a couple that have been divested, and the returns on those ones were very impressive. What we'd identify as the key risks is, and this is hardly unusual for fund manager teams or LIC investment teams, but there is key man risk in both the guys who are managing in Contact Asset Management, who are managing the direct equities portfolio, but also in the Pitt Street Real Estate Partners that are managing the direct property portfolio, we've got 2 guys in contact asset management. Although having said that, they're looking to build that team, which will mitigate that risk over time. And we've got 2 individuals in the Pitt Street Real Estate Partners. So it's just a risk to be aware of. Certainly from our perspective, hardly a deal breaker, but if the team was to lose a key member, then we by default will always reassess the investment strategy of the team. Yeah, we've issued a recommended rating. I think in terms of its investment merit, we see a number of points there. It's a differentiated investment product. It represents a strong thematic play and one that's unique in the Australian market. It's got a solid and proven investment team, both with the guys running the direct equities portfolio but also the direct property. It's a relatively cheap offering in terms of the management fees, 50 basis points MER, and I think a very well structured performance fee that aligns the interests of shareholders with the management team. In terms of investor suitability, well, as I said, it is a thematic play, so you do need to have a positive view on that thematic and the manager's ability to execute on that. Again, it's a high conviction mandate, so again, just the way it always with high conviction mandates, you do need to believe in the manager's ability to generate returns in line with the performance objective, and we think the team in that regard is certainly proven. Diversification benefits exhibits relatively low correlations to the broader ASX 200 market on the direct equities portfolio, and clearly on the direct properties portfolio. Again, that's relatively uncorrelated to the broader ASX 200. And the reason it is exhibiting that low correlation is if we look at the direct equities, it really excludes the financial services sector and the resources sector, which most retail investors are heavily overweight.